This is a download from BFM 89.9, the business station.
Good morning, Dodge. Now, last Friday we heard of GE's planned sale for its property portfolio to Wells Fargo and Blackstone. What do you make of the company's focus on its industrial business?
Good morning, Melissa. Well, I'm quite positive on their change in strategy. The strategy to have GE Capital as a big part of their business up to now has made a lot of sense, but the world is changing. The financial environment is changing. It's pretty clear that GE Capital is worth more detached from GE than as it has been. Its spin-off, GE's spin-off of Synchrony Financial last year, its private label credit card business, it was floated at $19 billion, and now it is trading at a market value of $25 billion. Also, GE has been able to sell its Australian consumer finance business to a KKR-led consortium for $8.2 billion, which was twice the book value. And we're hearing a lot of buzz in the market, mainly from private equity groups, for its remaining financial businesses. So I suspect they're going to do better with it spun off and not having to worry about the financial world that the finance business is involved with. Also, with this exit strategy, it's now able to get back to its roots, providing basic infrastructure needs around the world. And that is largely and potentially much more profitable business than lending. Two-thirds of the world's population doesn't have access to critical services in those areas, so GE will be able to fill a much broader set of market needs around the world. So I view this as quite positive, and the market is reacting accordingly.
Now, investors are looking ahead to the first quarter earnings season coming up. Reuters data shows that profits of company on the S&P 500 are projected to have declined by about 3% in the first quarter. Is this in line with your expectations?
Yes, it is in line, Melissa, and I do expect that there will be some additional volatility caused by this. It was a tough market, and even though there won't be as much of a pullback in terms of valuations because it was expected, and so the fact that the market itself has not really transitioned to pure fundamental analysis based on earnings. It's still involved with low interest rate environment, so that does add some cover for the short term. But what is really going to be important as we get into the earnings season is what we hear about the future, the impact of low oil prices, and the prospects, what they're forecasting for the future. That's really going to be driving the current valuations.
Well, the IPO market has been off to a slow start, hasn't it? Especially in the U.S. What do you think, Dodge, will resurrect its growth, and what kind of time frame do you think it will happen in?
Oh yes, Melissa. It has been much weaker than what we have seen in the past and what was projected. The broad market may well remain under pressure and experience larger swings in volatility in prices, and that's an environment that's much less conducive for convincing new companies to initiate the market entry. So that's one thing. The other thing is what we're seeing now. We're seeing that there's been a fairly active private market, which has both supply and demand working in its favor. And so we see tech companies, for example, they raised $1.2 billion in the first quarter by going public, but at the same time, they were able to raise $10 billion in private rounds, and that in part is caused by low interest rates. So I think that we're going to see additional pressure for the next 3 to 5 months in terms of the low interest rate environment, which seems to be supported by the expectation that the Fed is not going to be in a hurry to raise interest rates. But as we get into the third quarter, then I suspect we're going to see fundamental valuations coming back, and that there will be a real entry point for companies to go the IPO route rather than to go through seeking debt-related financing.
Right, and where is the sector rotation, Dodge, that you've mentioned in the past?
Well, right now we're seeing a continued rotation into auto parts, to foods, to healthcare. select internet-related issues, but you've got to be very careful. We are quite negative on the performance of Google. Now, that's not in terms of their fundamentals, but in terms of their stock. If you take a look at it, it is under a short-term pressure, and so you have to be really very selective on the internet area. Leisure products are doing well. Retail is coming back into focus, and I'm somewhat surprised by that, given the fact that the consumer really has not benefited from increasing economic growth yet. But we suspect that will be an additional area to look at. Retail. Solar is doing well. We're also looking abroad. We're looking over in your neck of the woods. We're seeing Hong Kong and China. There are a lot of stocks now that are behaving very well. Also, South Korea, we are looking to participate there on a general basis through ETFs. But in China and Hong Kong, we're beginning to look at specific stocks.
Thanks so much for sharing your thoughts. That was Dodge O'Dolan, Chairman and Chief Investment Officer at Landau & Fuse Capital Managers over in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.